What's up guys, my name is Nick and welcome to my channel. Today I'm breaking down one of my favourite strategies, the wheel. While the strategy is not overly complicated, it does require an understanding of both covered calls and cash secured puts. I've already made videos on both these topics, so be sure to check those out first if you don't understand what I'm talking about. I'll include a link to both of those somewhere up here. Okay, let's jump into the video. Be sure to stick around till the end though, as I'll be showing details of how you can get access to a free spreadsheet that you can download to help track your cash flows and position profit and loss over the course of running a wheel trade. With that said, let me jump onto my laptop and share my screen. I'll see you guys on the other side. Cheers. The first stage in setting up the strategy requires a selection of an appropriate stock or ETF. It's important that the vehicle you use to trade the strategy is one you are comfortable holding for the long term, since a trade will perform best when the stock or ETF trends higher over time. The stock should, of course, have options available to trade, and these should be as liquid as possible. Given the active nature of the strategy, the effects of slippage should not be discounted. So, options should have tight bid-ask spreads, plenty of volume and open interest, and there should be good option strike expiration availability. All these factors will give you more flexibility and allow you to more easily both enter and exit trades with lower costs. Finally, you will require sufficient funds available in your account to buy at least 100 shares of stock. Since a single stock option controls 100 shares, it's important you're able to take assignment of the stock if need be. The strategy involves the writing or sale of put options, and these should be what is known as cash secured. Okay, so let's begin by looking at a very simple binary model that runs the strategy using a single option or 100 shares of stock. We begin at point 1 by selling a cash secured put. When I say the model is binary, what I mean by that is we'll just have two very simple outcomes. By the expiration date, either the stock can go up and is above the strike price of an option, or goes down and will be below the strike price of an option. So, in the case of a put then, when the stock goes up, the put expires out of the money and is worthless. We simply get to keep the premium for which we initially sold the option. Remember, we are option premium sellers. We make money when the price of an option goes down, not up. In this case, we return to point 1 and begin the process again by writing or selling another put option. If the stock goes down, the put is in the money. The buyer of the put will exercise their right to sell you 100 shares of stock and you are assigned. You now move to point 2 on the flowchart and sell a single call option. Since you hold the stock 100 times already, the position is said to be covered. This is because any losses in the call option that occur above the option strike will be covered by the shares of long stock. Again, our binary model has just two possible outcomes. If the stock rallies, the call expires in the money, and the call buyer exercises their right to buy the stock from you at the strike price of the option. While you still get to keep the option premium, of course, your shares will be called away. Now, hopefully, if you've selected appropriate strikes and received sufficient premiums from all the previous option sales, you've received a total net credit. This is your profit so far. Now you go back again and begin at point 1, selling a single cash secured put. In the event the stock goes down, the call option expires worthless and you return to point 2, where we write another call against the stock. I hope you're beginning to see how potentially powerful this strategy can be, but to be clear, it is not without risks. If the stock does continue to fall in price, while the continuous sale of additional call options cycle after cycle will help reduce these losses, it is possible that premiums generated are simply not enough. Just to be clear, the wheel has lower risk than holding outright long stock, but if a counter does go to zero, think Enron, Lehman's for example, losses can be substantial. Some traders, like myself, mitigate these risks by trading the wheel on index ETFs like SPY or the Qs. While implied volatility is lower, which typically leads to lower returns when compared to single stocks, ETFs have little or no chance of going to zero, or the huge gaps in price that single stocks occasionally face due to company-specific announcements or earnings news, for example. As always, there's a risk-reward trade-off, and that comfort level will depend on you and your own specific objectives and risk tolerance. Before we move on to more practical tips in regard to selecting and implementing trades, let's take a look at a 200 stock, 2 option model, which is very similar to the model we just covered, but with a couple of nuances. Again, we begin by selling a cash secured put. If this expires in the money and we are assigned stock, as before, we sell a single covered call, but additionally now we also write or sell a cash secured put. Again, from here there are two possible outcomes. If the stock goes up, the call is in the money and the stock is called away. Our put option expires worthless though, and we collect an additional premium. We begin the cycle again by writing a cash secured put. If the stock goes down, we are assigned and now hold 200 shares. The call option expires worthless and we collect an additional premium. We now sell 2 calls in the next cycle against these shares and expect our stock to either be called away or for our calls to expire worthless. Whether the stock goes up or down will determine our next move, but I hope you understand how the basic cycle works now. Look at writing options with 30 to 45 days to go to expiration. Theta, or time decay, tends to accelerate as an option approaches its expiry date, and this time frame is appropriate to take advantage of this characteristic of options. Consider options around a 30 delta. We can think of an options delta as the probability of it expiring in the money. A 30 delta option then has approximately a 70% chance of expiring worthless, while added in money premiums at these levels tend to still be quite attractive. If you have stronger views about the near-term direction of the stock, in the money strikes are more bullish for puts because the strikes are higher, and more protective or bearish for calls since these strikes are lower. If you trade the strategy in a margin account, consider rolling your put option out in time to avoid being assigned shares. While covered calls and short puts have the same payoffs, your broker will require you to set aside more funds to hold the stock and the call option than it would just for the short outright put. If you are trading other strategies as well, this will allow more margin for additional trades. Be sure to keep a track of the cost basis of your stock by tracking all the debits and credits you incur over the course of the trade. All credits, whether that's the option sales, dividends, stock being called away, all lead to cash credits to your account and a reduction in the cost basis of any stock that you are holding. Debits, on the other hand, increase this net cost basis. Debits are generated when you are assigned stock or you repurchase any short options to close your positions out early prior to expiration. To help you with this process, I've written a very simple spreadsheet you can download, and in a moment I'll walk you through exactly how to input credits and debits into this ledger to make tracking your positions really easy. Finally, while I'm not a licensed financial advisor, there are certainly benefits if you're a resident in the United States to trading this strategy within a tax advantage account such as a Roth IRA or a 401k. Personally, I am trading out of Singapore, where at the time of making this video at least, there are no capital gains tax, so this issue is not relevant to me. As I say, look, I'm not a licensed financial advisor, and so I would strongly suggest you do your own research there or seek independent professional advice. Okay, let's open up the spreadsheet and take a look at how you can use it to track your trades. Okay, so here we are inside my desktop. I've got the Will Credit Debit Tracker open on my screens. This is the file within Google Sheets. I've included links in the description below. There's also a standalone copy that you can use in Excel if you prefer. Okay, so we're looking at Ford stock. I've picked that specifically because it's a relatively cheap stock, and you can trade the Will strategy on Ford for less than $1,000. So why don't we just walk through a couple of different trades and just see how we enter all these positions in the spreadsheet. So today's date is November. Today's date is November the 2nd, 20. Okay, and we begin the process by running a cash secure put. So there's drop-down menu here which shows the various credit actions you can take. We're writing a cash secure put. For contract numbers, we're going to sell one option, but that represents 100 shares. So rather than include a multiplier, simply put in the number of shares that option represents, 100. Okay, right now, with 33 days to expiration, the 7.5 put is worth around 37 cents. So I'm going to use that as the example here. Just out of interest, let me give you some numbers in regard to ROI. The cash required to hold that position potentially is $750. So the ROI, that's $37, is a 4.9% return over 33 days, which is 54.6% annualized. Okay, if we are assigned, the net purchase price for the stock will be $750 minus that credit received, which is $7.13. Okay, which is approximately an 8% discount, to the current stock price. We closed Friday's session at $7.73. Okay, so let's just say now we go on with the trade. Time passes. Obviously, the numbers that I'm going to have to invent. I'm going to have to invent them going forward. I'll try to make them as realistic as possible, but obviously we're not in the future as yet. Let's just assume that we allow this option to expire, and it does in fact expire in the money. So as a result of that, come December the 4th, which is the expiration date for this particular option, we're assigned stock. And again, all the debit actions are on the right-hand side of the screen. We're actually assigned a stock. Number of stock we assign is 100. And in the price, premium div per share, you would enter the strike price of the option. So that's $7.50. Okay. Now what it's trying to work out is, you notice here the adjusted running costs. It's showing a $713 debit. And that's because it's just, at the moment, it's just working out the difference between net credits and net debits. What we need to do is we need to tell the sheet what our current stock position holding is. We're now, of course, long 100 shares. So what it will do is it will give you your average cost basis. So the 713 is just a 750 strike less the credit received. And it'll also mark your overall P&L against this closing price here. Now, obviously, if we're moving forward in time and we've been assigned the 750 put, it's fair to assume that the stock price is trading below that. So obviously, let's say the stock was trading at 730. Then the profit is only $17. Okay, let me just put that formula back in. Okay, so now December the 4th, we begin writing covered calls against the stock that we now hold, the 100 shares that we're long. Okay, so we use a drop-down menu to put that in here. Again, we're going to sell one call option, which represents 100 shares of stock. And the price we can get for that, let's just say, is 25 cents right now. Okay, which is a $25 credit. Okay, let's just assume in this case the stock is relatively quiet, doesn't move, and basically the option just expires worthless. There's no cash flows here. You simply collect the credit and get to keep it. So that's the expiration for those options would have been January the 15th, 2021. So again, we're going to write another covered call. We're still holding the long shares, remember. Okay. Again, that's 100 stock. And let's just say we can sell that for 35 cents. Okay, that position is currently open. Now, coincidentally, Ford is due to pay a dividend on the 29th of January next year of 15 cents. So let's just say, for argument's sake, we don't want to have our shares called away, because if we have our shares called away, we won't be eligible for that dividend payment. Okay, so on January the 26th, then, we decide to buy back that current call option. So that's an option repurchase, so it's 100 shares. And we have to do so at a small loss. Okay, we have to pay 45 cents to get that back. And we're going to roll the option out in time. So it's January the 26th. And we're going to write another covered call against the shares we still hold. Okay, and this time we're going to receive a 45-cent credit. This option is no longer open. It's been closed rather than allowed to expire. And this current position is now open. As we move forward to January the 29th, then, we are paid a dividend of 15 cents. So you can input. So if we move forward to January the 21st now, we're paid that dividend of 15 cents. So it's a 15-cent dividend per share, which is a total of $15. There's no action here required because you simply paid, the cash is simply credited to your account. Okay, let's just close this cycle of the wheel out now and assume that the stock actually finally gets called away. Okay, so let's just say that's February the 19th is the option expiration date. The action, of course, is that the stock is being called away 100 times. And the strike price, let's say $8. Okay, so we receive a net credit cash there of $800. We now need to reflect that in the current stock position, which is now flat. We've gone through one complete cycle of the wheel and we're back at the stage where we'd be looking to sell cash secure puts. So the total net credits received over the course of all these various trades and actions is $162. Okay, thanks for your time, guys. I hope you enjoyed the spreadsheet. Be sure to download a copy for yourself. Cheers. Guys, if you made it this far, you made it to the end, and your support's very much appreciated. If you enjoyed the content, do me a huge favor and hit the subscribe button down here to enjoy any upcoming content. I publish new videos on a weekly basis, or you can click over here to watch another video. I've added a playlist on other option strategies that I've made on the channel, which hopefully you'll enjoy as well. And if you didn't like it, well, what are you still doing here? Guys, I'll catch you on the next one. Cheers.